Hello, welcome to this Ned Davis Research podcast, where we will help you see the signals. My name is Brian Sanborn, NDR's Global Head of Investment Solutions. In this episode, we'll be speaking with NDR's Senior U.S. Economist, Veneta Dimitrova, about the next decade through our long-term capital market assumptions. Veneta, as you think about the next 10 years, what shapes your views for economic projections and asset class performance?
Thank you, Brian. We believe there are 5 major themes that will impact the global economy and the investment world over the next decade. 2 of the 5, investments in artificial intelligence and the energy evolution, should boost productivity and potential growth. Given that the U.S. economy is highly services-oriented and its labor markets are more dynamic than in other developed countries, which allows for rapid AI adoption, we expect the productivity gains from AI to be felt sooner and be more material in the U.S. than elsewhere. Also, U.S. energy independence provides a level of security against external shocks. It gives the U.S. a competitive advantage when it comes to the growing energy needs of AI and data centers. However, the remaining 3 themes, aging demographics, receding globalization, and global fiscal challenges, temper the global growth outlook. Slow projected population growth in most of the developed world, shrinking populations in Japan and China, and aging demographics overall impact to a large degree our subdued global growth outlook. To protect against tariffs and shortages, countries will continue to diversify their supply chains, a trend that had started post-COVID. Nearshoring, or ally shoring, if you will, generally involves higher costs and favors security over efficiency, and it implies a drag on productivity growth and tends to be inflationary. Finally, the IMF projects the gross government debt as a share of GDP will continue to trend up across most countries. Some potential implications of worsening fiscal health include higher interest rates and inflation, less government spending, and crowding out of private investment, all of which imply slower growth and slower aggregate demand. These themes, incorporated into our economic models, refined by our strategists, and transformed into asset class returns, risk, and correlations, provide a valuable insight to long-term asset allocators.
Veneta, what are your projections for economic growth and inflation?
On net, we expect somewhat slower global real GDP growth and lower inflation through 2034 than over the previous decade. The growth outlook for the U.S. is slightly better than this year than in last year's CMAs, largely due to stronger productivity. Productivity is also why the U.S. economy is expected to outperform other developed markets. Although protectionism is a long-term negative for growth, reshoring of production and energy investments could provide an intermediate-term boost to aggregate demand. Higher interest rates, however, we expect will act as a drag on growth relative to the prior decade. Although inflation has moderated, it has yet to reach many developed economies' central banks' 2% targets. Receding globalization, tariff war threats, increased organized labor demands, swelling government debt, and more geopolitical conflicts support elevated price growth for the foreseeable future. Compared to last year's CMAs, our inflation projections through 2034 are slightly lower in the US, UK, and the Eurozone, around 2 to 2.5%. This is below the previous decade, which was skewed by the pandemic. Inflation in Japan is expected to back up relative to the prior decade, while inflation in China is expected to recede as a result of weak domestic demand, excessive private sector debt, and shrinking population.
Putting all of this together, what does that imply for asset class performance over the next 10 years?
Compared to the last year, our 2025 equity return assumptions show the biggest change in the US. We expect 6.9% annualized return in US large caps for the next decade, down from 8.8% in last year's CMAs. This is mostly driven by the rich valuation starting point in a mature secular bull. Expected returns in the rest of the developed countries are also slightly lower, but generally close to the 2024 CMAs. Regarding fixed income, elevated starting yields point to higher return expectations compared to the prior decade and to last year's CMAs. Our macro assumptions for real growth and inflation imply that yields will remain elevated over the next decade. The projected increase in government debt across countries contributes to this upward pressure on yields. For the US, that means a 10-year nominal yield averaging close to 5% over the next decade. For other assets, we expect the US dollar to weaken slightly amid policy cross-currents and because of current overvaluation based on purchasing power parity. Gold should continue to appreciate in line with its long-term trend, partly due to a growing mistrust in fiat currencies. Persistent inflation and a slightly weaker dollar are also tailwinds to gold prices. Commodities and real estate are likely to perform better than in the past decade. Increased protectionism, reshoring, and increased geopolitical risk point to an upside risk to commodity prices over the long term. Commercial real estate, though, has started to stabilize, with only office still experiencing deep negative returns. We expect the normalization of market conditions to take several more years and to vary by property sector.
Veneta, thank you for your insights. NDR clients can read Veneta's research notes in her U.S. economic focus publications. The indicators Veneta and the research team developed for our subscription service are also used in our model portfolios, which are available for direct delivery, on TAMPs, and as ETFs. For more information on NDR, we encourage you to visit ndr.com. Also, for those listening in audio-only mode, video versions, including charts of See the Signals, are available by going to info.ndr.com/ndr-signals. Thank you for joining us as we help you to see the signals. So long.